Well, our next guest is a well-known value investor who's here to give us picks that he says can weather any momentary blips. One of the best mutual fund managers, according to data that we keep here at Bloomberg, and he was also voted a finalist for Fund Manager of the Decade by Morningstar. That's Don Yacktman, Chief Investment Officer at Yacktman Asset Management. Heck of a setup there for you, Don. You're going to tell us how not to lose money in some of these volatile sessions, perhaps over the next 6 months. How do you do that?
Well, we are bottom-up investors. We buy them one at a time, and from that I can kind of gather kind of general thoughts. But what strikes me now is that it's the high-quality companies that are the best relative values out there. I mean, our biggest holdings are things like Pepsi-Cola and Coke. And those are not exactly low quality. No,
but you added recently in the healthcare sector. You're not afraid of a bigger government having more of a role in the healthcare space. You're finding opportunity there.
We are. Well, our biggest holding in that area is Pfizer, although we have added Bard and Becton Dickinson to the list, but as well as Johnson & Johnson virtually being a top 10 holding. Pfizer is the one that kind of stands out. That's the biggest drug company. And yes, I think what we will see is we will see more volume, but they will give on margins. And Pfizer is gradually going to move to more complex drugs, which are going to be more difficult to get in generic form.
You're also adding in C.R. Bard as well.
Mm-hmm. Yeah, I think of these as fit the business model of what we like to look at, which are businesses that have high return on assets, and these are disposable product companies. Again, that low asset component, high margins, high returns. We look at things like bonds and think of these as high coupon bonds that are selling below what other similar high coupon bonds are selling at.
Mm-hmm. What are fund flows like right now, Don? Because we keep talking about the smart money having been in this market. Look at the gains in the S&P 500, but we've been hearing so much about a retail investor still driving with the brakes on. What are you experiencing?
Well, I think what we're experiencing is kind of unique in the industry. I mean, we've had just a flood of money coming into our funds pretty much for over the last year. And I think part of this is that the average investor tends to be a little bit short-term, although in our case it's both a very good short-term number over the last year or so, as well as the 10-year number, which is off the charts.
So give me a sense of what fund flows are like now versus 2006.
For us?
Yes.
Well, I'd say in 2006 it was pretty neutral. I mean, we didn't have much flows in the fund. Now we're getting probably close to $20 million a day between the two funds, the Yacktman Fund and the Yacktman Focused Fund.
So when we look out across the market, I mean, we're, 318 companies through the S&P 500 in terms of those having reported earnings, and expectations are being beaten here by about 13% were the figures I just saw from Morgan Stanley there. I mean, is this still just a matter of low expectations? How do companies keep up performance given that now there's a new sense of optimism perhaps here in the U.S.?
Well, I think as you come out of a deep recession like this, that there's just some enormous leverage that occurs, and certainly the market in the short term has been focusing on the more economically sensitive businesses, and they have driven up the prices of those businesses very high to very optimistic levels. And again, I'm overgeneralizing, but that's kind of what we're seeing, and that's why we're focusing on those that have probably more defensive characteristics. It's not that we're looking at it from the top down, but from the bottom up. But that's what we're seeing.
You have a lot of money in some of the biggest names out there, some of the behemoths, but it's hard for an investor who does want to sort of make up what they lost in the downturn to not chase growth or not chase some yield there. I mean, how do you make them feel confident that the best bet is in one of the behemoths out there, like a Pepsi or a Microsoft or a Johnson & Johnson, not one of the necessarily new economy names?
Well, I don't think people do very well when they drive their car forward looking in the rearview mirror. And I think the best thing is to be objective and to be patient. And we're trying to do that, and we're trying to find the best returns that we can find over the long pull. And we focus on a 10-year horizon time, a very long horizon time, because we know that in the short term things can be way out of whack, but in the long term we feel very confident in what we're doing.
All right, and you're not putting any money to work in the airlines despite this merger today?
I learned my lesson in the 60s.